Most of the panicked headlines you see regarding the Australian housing market focus on volatility. They paint a picture of a system in total chaos, and for the average observer, that is a reason to retreat. Major economic shifts, specifically potential international tariffs, are expected to push the Reserve Bank of Australia toward multiple interest rate cuts in the near future. This creates a surface-level impression that waiting for a better deal is the logical move. However, buyers who delay their entry by 6 to 12 months often find themselves in a losing race. As shown here, stagnant savings are quickly overtaken by rising property values, costing the buyer tens of thousands of dollars in lost equity. There is also a disconnect between the official cash rate and your mortgage. Banks frequently maintain higher interest rates even when the RBA cuts them, using the difference to pad their own profit margins. Expecting a macroeconomic shift to solve the affordability crisis is a significant mathematical error. In this market, the cost of inaction is often higher than the cost of the property itself. Despite these pressures, a minority of first-time buyers is securing high-value properties without the typical struggle. These buyers prioritize technical financial criteria over the lifestyle-driven choices that guide the broader market. Their success is built on information asymmetry, a deep understanding of the internal mechanics that the banking system uses to evaluate every transaction. Learning to navigate the system is the only reliable way to bypass the hidden obstacles that routinely drain $200,000 from average buyers. Banks do not make decisions based on your loyalty or your personal story. They operate on a rigid set of automated benchmarks. Two primary metrics dictate your success: serviceability and the loan-to-value ratio, or LVR. Serviceability measures your verified ability to repay the debt, while LVR is the size of your deposit relative to the property's price. Carrying unoptimized debt, such as a large car loan or an active credit card, reduces your serviceability score. This often leads to an immediate rejection, regardless of how high your salary might be. Tactical buyers reverse engineer this process. They calculate the exact income required for their target property and restructure their financial profile to meet the lender's requirements before they ever apply. Securing a loan is a matter of formatting your financial data to align with the specific internal logic of the banking algorithm. The traditional requirement of a 20% deposit acts as a primary barrier that has effectively locked a generation of buyers out of the market. Recent updates to federal government policy have introduced an alternative. The expanded First Home Guarantee allows eligible buyers to enter the market with a deposit of only 5%. Utilizing this scheme significantly accelerates your timeline. By removing the need for a massive upfront deposit and bypassing strict income caps, buyers can often purchase years earlier than originally planned. These guarantee schemes provide the strategic leverage necessary to gain immediate market exposure while prices continue to climb. Once your finance is ready, the focus shifts to the property itself. Statistics suggest that roughly 85% of homes on the market contain structural issues that make them poor investments. You must use professional building and pest reports as a filtering tool. This allows you to identify hidden structural rot or pest damage and avoid taking on someone else's financial liabilities. Strategy is also key in location selection. In a market like Brisbane, savvy buyers look for sister suburbs, undervalued neighborhoods adjacent to high-growth zones benefiting from the ripple effect of new infrastructure. You can further protect yourself by including strict finance clauses in your contract. This ensures you can exit the deal without penalty if the bank's final valuation does not match the purchase price. This defensive approach treats the acquisition as a technical protocol, removing the emotional impulse that leads to overpaying. While most buyers view the purchase as the end of their journey, strategic investors see it as the beginning of a wealth generation phase. New regulations allow first-time buyers to rent out individual rooms immediately. This generates a secondary stream of income that directly subsidizes the mortgage and accelerates the debt reduction. Rapidly reducing your debt creates the equity needed to secure a second loan. This allows you to transition from a single homeowner to a property investor in a fraction of the usual time. The first property provides the seed capital required to launch a generational property portfolio. The housing market operates as a mechanical system governed by specific, predictable mechanics rather than luck. The educated minority succeeds because they align their actions with these internal rules, while the uninformed majority remains frustrated by the surface-level volatility. Understanding this information asymmetry allows you to transition from a reactive participant to a strategic operator. Once you understand the mechanics of the system, you can stop guessing and start playing to win.